This is part 2 of my Opendoor stock analysis, and if you're interested in watching part 1 where I talk more about the company and Q1 results, you can find the link to the first part of the video in the description below. With that out of the way, let's continue with part 2 of the analysis. Now let's take a look at the company's balance sheet. So Opendoor's business model is considered capital intensive as the company needs to tap into the debt markets to buy homes and ultimately to fund growth. As such, we can see that Opendoor has a negative net cash position. As of Q1, the company has $1.3 billion of cash and short-term investments with total debt of about $4 billion, which makes their net cash position to be about negative $2.7 billion. However, I do not see any substantial default risks as Opendoor's balance sheet is highly liquid with a current ratio of 11 times. The company also took measures to reduce its debt balance in Q1. More specifically, Opendoor invested $101 million to repurchase $189 million of its outstanding 2026 convertible notes at a 46.5% discount to par value. In addition, the company closed down one of its financing facilities, and altogether Opendoor reduced $1.4 billion of debt on a quarter-over-quarter basis, which I think is really clever of management given the current macro environment. In terms of inventory, Opendoor ended the quarter with 6,200 homes in inventory, which is valued at about $2.1 billion. This figure is down 53% from the prior quarter, and approximately two-thirds of the inventory balance consists of the old book, as you can see here. The new book, on the other hand, make up the remaining third of inventory. So Opendoor also ended the quarter with $187 million of inventory valuation adjustments against its gross inventory balance of $2.3 billion. This adjustment is management's estimate of future losses that Opendoor may realize on these homes. But notice that Opendoor's new book inventory valuation adjustments represents only 0.4% of inventory, which management claim that it is consistent with historical performance. This means that the housing market has pretty much stabilized. It is also worth mentioning that 20% of Opendoor's new book of inventory had been listed on the market for more than 120 days versus 23% of homes on the market. So the lower the number, the faster the inventory rate, which is what we want to see. And in this case, Opendoor's new book is being sold faster than the general market, which is great to see. Turning to free cash flow, Opendoor's business model is extremely capital intensive and it is quite hard to predict its cash flow. But it is safe to assume that if free cash flow is negative, the company is a net buyer of homes, and if free cash flow is positive, the company is a net seller of homes. As it turns out, Opendoor has been a net seller of homes in the last 2 quarters, and in Q1 alone, the company generated $2.2 billion of free cash flow, which is a 69% free cash flow margin. I expect Opendoor to continue to be a net seller of homes as the company continues to sell its old inventory. With the cash proceeds, I expect the company to delever its balance sheet or maybe buy back some shares at current prices. And when the housing market really stabilizes or when interest rates fall, I expect the company to be a net buyer of homes once again. So overall, I believe Opendoor has a strong balance sheet, and as an Opendoor investor, I'm happy with how management is allocating capital, managing debt balance, as well as lowering inventory exposure. Now, in terms of outlook, management provided the following guidance. So in Q2, management expects revenue to be about $1.75 to $1.85 billion, which if we take the midpoint of the guidance, it represents a 57% year-over-year decline. Adjusted EBITDA is expected to be between negative 180 and negative 200 million, and stock-based compensation is expected to be in the range of 30 to 35 million. Adjusted operating expenses is also expected to drop from 100 million in Q1 to $90 million in Q2. So in the Q1 shareholder letter, management also provided extra details on their guidance. So heading into the rest of 2023, management maintains a cautious approach, and based on typical housing seasonality patterns, management do not expect to reduce spreads in the second half of the year. On the resale side, management expects to sell nearly all of the remaining homes from the Q2 cohort by the end of the second quarter, which means that Q2 will be its final quarter of negative contribution margin. So as the company transitions to selling more of the new book of inventory, we can expect expect positive contribution margins in the back half of the year. And finally, management is also laser focused on managing its cost structure and is committed to returning to positive adjusted net income at $10 billion of annualized revenue by mid-2024. Other than management's guidance, we can expect continued traction in some of Opendoor's recent initiatives. This includes its 3P marketplace exclusives, and the company has launched exclusives in certain markets, and management believes that exclusives is a good way for the company to continue to gain market share and grow without adding inventory exposure, capital intensity, and macro risks. Management did mention that by the end of 2023, its goal is to have 30% of transactions going through exclusives in those markets where marketplace has been launched. During the Q1 earnings call, management mentioned that there's early and promising traction for its marketplace product offering. So for example, in Plano, Texas, they are converting more than 60% of sellers that the company pitched to enroll in exclusives, which is really high. And in less than a quarter, the company drove over 3% listing market share, which is good progress, but still a long way to go to 30% market share for exclusives. Spreads, which is the difference between the price offered by Opendoor and the market price, is expected to remain high as the company navigate through a challenging macro environment. Higher spreads means lower seller conversion, thus lower home acquisitions for Opendoor. And the reason why Opendoor wants to maintain higher spreads is due to the fact that the company wants a large margin of safety when acquiring homes. So as the housing market stabilizes, the company expects to reduce spreads, leading to an increase in conversion, which will translate through to higher acquisition volumes. Next is the recently announced multi-year partnership with Zillow, which allows Opendoor to drive brand awareness and acquire customers through the Zillow funnel, which has more than 200 million average monthly unique users to the website. Not only that, but Opendoor also expanded its partnership with Redfin and Realtor.com to all of Opendoor's markets, which should drive additional sellers to the Opendoor platform. So while Opendoor is maintaining higher spreads in its offers, the company is expanding its low-cost partnership channels with the top 3 online real estate platforms to attract more sellers to the platform. In other words, these partnerships should drive higher traffic to Opendoor's products, which not only should offset the lower seller conversion from higher spreads, but also allows Opendoor to acquire homes at attractive prices. It is also worth mentioning that Opendoor consistently outperformed market expectations. So if we head on to Seeking Alpha, we can see that the company has outperformed expectations and beat analyst estimates in all of its quarters as a public company. So moving forward, I won't be surprised if Opendoor outperform expectations once again. Now let's talk about the valuation of Opendoor stock. If you're an Opendoor investor, you're probably at a deep loss as the stock has lost more than 90% of its value. Today, the company is pretty much a penny stock trading at $1.79. The stock even hit $1 a share back in December. However, the stock has recovered from its lows, although it's still way off from its all-time high of $39 a share. Also, the company just reported strong Q1 earnings results, which saw the stock surging 30% plus the following day. The question is Opendoor stock still a buy today? Let's find out. So in terms of EV to revenue multiple, Opendoor is trading at about 0.3 times, which is incredibly low in my opinion. This is also way lower than its highs of about 7 times back in January 2021 when it went public. So based on historical multiples, I see deep value in Opendoor stock. We can also see that Seeking Alpha gave Opendoor a valuation grade of A+, which means a great value for Opendoor investors today. On the other side, Wall Street maintains a hold on the stock with only one strong buy recommendation. In terms of price target, analysts have an average price target of $2.76 per share, which is a 54% upside from here. The price target ranges from as low as $1 a share to as high as $8 a share. Now here is my DCF model on Opendoor, and as you can see, these are my key assumptions. So for revenue growth, I followed analyst estimates for the first 3 years by plugging these revenue growth rates into my model right here, and then I'm going just to bring it down to 15% revenue growth by the end of 2032, reaching a $50 billion revenue run rate by 2032. So assuming a $2 trillion residential real estate industry, this is only a 2.5% market share for Opendoor, which is very feasible in my opinion. So back in May last year, Opendoor released its investor presentation, which shows its long-term margin targets, and based on management expectations, the company is expected to have a long-term adjusted gross margin of 10 to 11%. So that is what I'm going to model in my DCF model. So if we head back to my model, I'm going to assume a 95% gross margin in 2023, and then it's going to improve to 90% by the end of 2032 as the company achieves economies of scale, as well as the expansion of Opendoor Exclusive, which has higher gross margin profile than its iBuying business. So in its investor presentation, management also provided adjusted net income margin target of about -2 to 4% right here, which is an appropriate proxy for operating free cash flow. So I'm gonna use that as my free cash flow margin in my projections. So with that said, it doesn't really matter what I put for my assumptions right here, as I want a free cash flow margin of between -2% to 4%. In this case, I assume that Opendoor achieves a free cash flow margin of about 2.5% by the end of 2032, which is slightly higher than management's midpoint long-term adjusted net margin target of -2% to 4%. The reason for this is that I believe Opendoor Exclusives, which has higher margin than the iBuying business, it will be accretive to free cash flow margins in the long run. So based on my assumptions, I expect a $50 billion revenue by 2032 and a free cash flow margin of 2.5%. And assuming a 12% discount rate and 2.5% perpetual growth rate, I arrive at an intrinsic value per share of $5.67. So yes, that is how much I think Opendoor is worth, and I think Opendoor is severely undervalued based on current prices. But I'm not a financial advisor, so don't forget to do your own due diligence. So with my intrinsic value per share of $5.67 and based on the current price of $1.79, it represents an upside of about 217%. So yes, Opendoor is very undervalued in my opinion. Maybe that is why institutions are loading up on Opendoor stock as the stock continues to fall right here. So this should be a confidence booster for investors. So turning to the risks, I think the first risk is more banks collapsing in the next few quarters. So to kick off 2023, 3 banks collapsed, and although this number pales in comparison to the hundreds of banks that failed during the Great Financial Crisis, the total assets held by these 3 banks were much larger than the assets held by the hundred of banks that failed during the Great Financial Crisis. In addition, lots of mid-sized regional banks loaded on commercial real estate when interest rates were near zero. With the higher CRE loans in their balance sheets, these banks are under a lot of pressure as a significant portion of these loans will have to be refinanced at higher rates, making these banks vulnerable to defaults. Even super investor Charlie Munger is worried about this, so if we see more banks failing due to commercial real estate defaults, Opendoor could see downward selling pressure as investors sell anything related to real estate. The next risk, in my opinion, is higher interest rates. Since March 2022, the Fed has raised its benchmark rate multiple times from 0.25% to 5.25% as of May this year. A high interest rate environment is not good for most businesses, let alone a capital-intensive, unprofitable real estate business like Opendoor. For consumers, mortgage payment costs will be higher, thus decreasing affordability and demand for homes. For Opendoor, it means a higher cost of capital to fund home acquisitions. As the cost of debt rises, margins are likely to be compressed as well. But I want to show you this chart. As you can see, home prices continue to trend upwards regardless of how high or how low interest rates are. So this should be a long-term tailwind for Opendoor. And last but not least, I think another housing crash could really significantly impact Opendoor's operations. So the collapse in contribution profit margins tells me that Opendoor's pricing algorithm is not agile or advanced enough to respond to rapid changes in the housing market. I understand that the housing shock that we've seen in the past few quarters seemed to be a once-in-a-half-century event that no one, including Opendoor, saw coming. But there's one thing we can't deny is that Opendoor's pricing algorithm failed to take into account a sell-off of this magnitude. And another housing crash means that Opendoor has to liquidate inventory at prices below what it paid for, thus producing negative margins which could add pressure to Opendoor stock. So what do I think about Opendoor stock? I think I can sum up Opendoor's investment thesis in just one sentence. Opendoor operates in a massive industry with only 1% market share, and the company is virtually a monopoly in the iBuying business with technology, scale, brand, and network effects moats, which means substantial and sustainable growth opportunities for Opendoor for years to come. This thesis still stands even in this market environment, and the stock is now down 90% from its all-time highs, which provides a large margin of safety for Opendoor investors. Although the company is facing a challenging macro environment characterized by rising interest rates and volatile home prices, management is doing everything they can to balance risk, growth, and profitability, which makes me a really happy investor. And we can see that management is executing really well as seen by the Q1 outperformance. So for me, I'm going to continue to hold Opendoor stock, and if I see further weakness, I might add to my position. Well, that is it for today's video. What do you think about Opendoor stock? Please let me know in the comment section down below. And if you do like this video, please don't forget to like it and subscribe to my channel so you won't miss future videos. Thank you and see you guys on the next video.